Our next guest joins us to talk about the drivers. He's Jim Bianco, president of Bianco Research. He says inflation is coming back, and that's all the reason the Fed needs to raise rates. He joins us right now, live from Chicago. Jim, great to have you back on Street Smart. So, Fed interest rates, they met this week, not too much news as expected. How soon do you think they'll need to raise rates, and how quickly?
I think that if my premise is correct and that the inflation numbers are bottoming out right now and they're going to start moving higher throughout the second half of this year, they could start the exit strategy before the end of the year. They will be compelled to want to move at that point. Even though the inflation numbers might bottom out and start moving up, and by some measures they'll be very small, we're at 1.1% on core inflation, and maybe it starts moving towards 1.5 by year end on its way to 2 next year. Doesn't sound like much, but when the Fed's at 0 and wants to stay there, that's problematic for them.
So where do you think we could see inflation really take off? I mean, obviously, a lot of people argue that when it does pick up, it picks up too fast to react to.
Yeah, I think so. I'm more looking at it from a statistical standpoint in that what has been the driver of inflation down through now, and it's largely been the rent component or the shelter component of inflation. They measure rents, and that's how they come up with housing inflation. There's been a first-time homebuyers tax credit. It's encouraged people that rent to move into buying homes. It's lessened the demand for rents, and you've seen that show up in core inflation numbers. That first-time homebuyers tax credit expires tomorrow, and no one is moving towards extending it. And I think once it expires, you're going to see a stabilization in rent prices. And when that happens, you could see the inflation numbers start to turn around and move higher.
Jim, when the Fed starts to raise rates later this year, I mean, how aggressive are they going to be in those moves? Are they going to be very, very slow, very, very gradual?
See, first of all, I think what's going to happen is the Federal Reserve, it will eventually be at 12, probably by this summer. And they don't tolerate dissents. Usually all the votes are 11-0, or 11-1, or 12-0. And we've already got one dissenter. And we've noticed that in the statement, the dissenter, Tom Hoenig, has been getting more and more space to explain his dissents. And I think that shows that there are a number, 3, 4, maybe 5 Fed governors that are very uncomfortable with the current state of policy. What could happen if the inflation numbers move up is we could see 2 or 3 dissenters show up. Now, we won't have a vote that's 9-3. But they'll threaten a dissent, and then the whole body of the Federal Reserve will probably then lean their way in order to get them to continue to vote with them. So we could see considerable period go. We could see asset sales. We might even see a rise in interest on reserves. Depends on which way they go, but they will start it if the inflation numbers move up, I think, within the next 6 to 8 months, which is year end.
When do we actually see then the Fed funds rate, target rate go up? Because we were talking yesterday with Randall Krosner, and he suggested that this is really an insurance policy because a lot of Fed board members are still concerned about a double dip, still concerned about the problems of sovereign contagion. I mean, there are obviously a lot of headwinds out there that you could worry about.
Randy's right. The majority of the members of the Fed are more concerned about a downturn in the economy. But the minority, that is the hawks, have the benefit that 3 of them could push policy because they don't want to show a 9-3 vote. I think that if they get the evidence, they'll start to see it move. And I suspect what you might see is a dropping of the extended period language and maybe some asset sales to begin with. That would be what I think would happen. The last thing that probably would happen is they'll raise rates. But once they start in the asset sales, that is a de facto tightening. So the Fed would be tightening then at that point.
All right, Jim, so add it all up. I mean, what's kind of then the backdrop for the equity markets in your view? I mean, we saw some nervousness this week. We saw a sell-off with that Greece downgrade. What's the outlook here?
Well, I think the market is now rallying on the hope that we're going to get another bailout announcement for Greece. This will be the 5th one since January this weekend, and that this will be the magic one that's going to end the crisis. I'm not so sure that this is going to be it. It's going to be a lot more difficult than people are letting on to putting together a Greek bailout, and we might be disappointed. If we get a Fed rate hike, I think that zero funds rate has been pretty much a driver of this rally for the last several months, and definitely a driver in the financial sector, especially with their booming earnings. A raise in rates would flatten the yield curve, and that would probably put a big damper on what we've seen as the major drivers of not only financials but the market in general.
Hey, just quickly, only about 20 seconds left, Jim. I'm assuming you think that Greece does need an actual cash bailout to come through at some point soon. Do we see a point, you think, when Spain, when Portugal also end up needing cash bailouts?
Only if they mess up on the Greece bailout. The Greece bailout's going to be tricky because they're going to need Greece to agree to a lot of cuts in their spending and a lot of cuts in their social programs, which they adamantly don't want to do. But if they don't get the Greece one right, then the contagion could definitely spill into Portugal and Spain, and the problem could mushroom into something much bigger.
All right, hey, Jim, thanks very much. Jim Bianco, they're joining us from
Thank you.
Bianco Research in Chicago.